When you reach the intermediate phase of your trading career, you face a distinct choice. You have to decide between pursuing passive income by automating and copying professional trades, or retaining complete execution control by manually analyzing the markets yourself. Many retail participants treat this as a straightforward math problem, assuming the best option is whichever method produces the highest gross monetary profit. The reality is that neither approach guarantees a positive return. Both manual and copy trading carry heavy, unspoken operational costs that consume your capital and energy before a single dollar of profit is realized. Deciding between the two requires a strategic assessment of your personal resources. You must weigh the amount of time you can realistically spend against the level of autonomy you require over your capital. The industry standard for evaluating success is return on investment, or ROI, which is typically presented as a simple percentage of monetary return on your initial capital. Relying solely on standard ROI creates a blind spot for independent traders, as it completely ignores the massive personal inputs required to generate those returns. This graphic shows the standard ROI formula. What it hides are the dozens of hours spent studying charts, the psychological fatigue of managing losing positions, and the invisible execution fees that erode your bottom line. A more accurate metric is true ROI. True ROI calculates your actual generated value by subtracting your invested time, your emotional tax, and your operational slippage directly from your gross profit. To build a trading account that survives multiple economic cycles, you have to optimize your strategy for true ROI rather than chasing the highest advertised percentage yields. Manual trading demands a heavy physical input, often requiring upwards of 10 hours a week dedicated purely to technical chart analysis and tracking macroeconomic calendars. In exchange for this time, you develop lifelong analytical skills and maintain absolute 100% execution autonomy over your portfolio. The first hidden cost of this autonomy is a steep learning curve. New manual traders must absorb inevitable financial losses early on, a cost effectively categorized as market tuition. The second and far more destructive cost is emotional fatigue. Battling the daily physiological responses of greed during winning trades and fear during drawdowns exhausts your decision-making capacity. This emotional fatigue often triggers revenge trading. Revenge trading is the emotional act of abandoning your risk parameters and taking low-probability setups in a desperate attempt to win back recently lost capital. This graph illustrates the outcome of that emotional spiral. After a small loss, you increase position sizes, represented by the thickness of these vertical bars, rapidly dragging the overall account balance toward zero. By bypassing your strategic edge, you deplete equity and trigger a margin call. A margin call is a demand from your broker to deposit additional funds immediately or face the forced closure of your active trades. Manual trading gives you the ultimate authority over your capital, but it requires you to conquer your own psychological flaws before you can extract consistent profit. Copy trading operates on the opposite end of the spectrum, requiring you to cede all trade execution and risk management decisions to a designated master trader. This provides immediate time efficiency, removes the need for daily screen time, and allows you to instantly diversify your capital across asset classes you haven't studied. The trade-off is that you are a locked-in passenger. If the master trader's specific edge fails in current market conditions, your portfolio absorbs the exact same losses. To measure this hidden risk, you must evaluate their maximum drawdown. Maximum drawdown is a metric that calculates the largest peak-to-trough decline in a trader's account balance over a specific period. These equity curves demonstrate different risk profiles. The smooth green line tracks a steady trader, while the jagged line represents a high-risk trader, showing 150% monthly spikes. Allocating capital to these spikes means exposing your account to the 50% drawdown required to achieve them. Copy trading does not eliminate the need for analysis. It simply redirects your effort from reading technical charts to auditing human behavioral metrics and risk data. Automated replication also introduces a specific mechanical tax to your trades, execution risk, and slippage. Slippage is the pricing discrepancy that occurs when the actual execution price of a trade differs from the price at which the master trader initially placed the order. This mechanical delay is severely amplified during macroeconomic shifts, such as when major central banks release interest rate data and institutional volume floods the market. A manual trader can react to a sudden news drop by instantly tightening their stop loss, whereas a copied account remains subject to network latency and the volatility of delayed order fills. Relying blindly on automated execution during high-impact market events will quietly drain your capital through invisible pricing inefficiencies. You do not have to restrict yourself to being an exclusive manual purist or a complete copy trading passenger. This diagram illustrates the core satellite approach, a portfolio architecture used by experienced traders to integrate the strengths of both methodologies. The core function holds the majority of your capital. You actively manage this portion manually in familiar markets, preserving your execution skills and enforcing strict personal risk limits. The satellite function takes smaller fractions of your capital and allocates them to highly vetted copy traders. This diversifies your exposure into unfamiliar assets without requiring hundreds of hours of new research. This hybrid architecture optimizes your true ROI by leveraging your manual competency where you have a proven edge and outsourcing your diversification to preserve your time. If you have fewer than 5 hours a week to dedicate to the charts and find yourself making emotional decisions under pressure, weight your portfolio heavily toward audited copy trading. Conversely, if you want direct accountability and have the time to build lifelong analytical skills, weight your strategy toward manual execution, strictly limiting your risk to 1 or 2% per trade. Regardless of your structure, you must use a platform that offers negative balance protection. Negative balance protection is a broker guarantee that ensures your account balance cannot drop below zero, securing you against extreme market gaps. You can test your personal allocation risk-free using an FXNX demo account, utilizing their 0.0 pip spreads for manual trading or browsing their transparent copy networks to evaluate master traders. Long-term consistency in the markets comes from objectively aligning your trading architecture with your actual psychological tolerance and your daily schedule.